Good afternoon, boys and girls. Mr. S. Unit 4, Chapters 30 and 31, Money and Banking and Monetary Policy. Let's get to it. This is not a long one. I think this is an easy one. It's 20 multiple choice and a show me page. Let's start with the show me page and then work through multiple choice. And a lot of the show me is in the multiple choice. Got to know about the Federal Reserve, 3 tools: OMO, which is open market operations; DR, the discount rate; RR, the reserve requirement. Please know them and spell them all the way out. I do not want just initials on this test. Which tool do they use most often? OMO. Why? Because it has the most immediate control. The feds can watch results better. They can force things to occur. The other choices, discount, reserve requirement, do not have the same immediate control. Please know the multiplier formula, 1 over the reserve requirement, and how to get it. When we're talking about banking in the show me page, I need to know the 3 things that keep the multiplier from expanding fully. And that is: 1, banks do not lend out all of their excess reserves. 2, people do not borrow all of those excess reserves. And or 3, people do not redeposit all of the excess reserves if they are lent out. So one of those 3 things occurs, we do not get the full multiplier effect. Know the difference between the federal funds rate and the discount rate. Federal funds, the rate of interest bank to bank. Define the discount rate of interest, Federal Reserve to banks. And traditionally, the difference and why the banks may want to borrow at the discount rate versus the federal funds rate: the discount rate might be lower, it might be a last resort, or time. Federal Reserve will give you much longer terms on loans than federal funds and other banks will. All right, so if you know all of that there, you've got the show me page. All right, overall, we talked about money. Know M1, M2. We talked about knowing the medium of exchange, standard of value, store of value. Please know that about money. We talked about the reserve requirement and the formula to get it. Please know how to do it, the expansion multiplier. Talked about the federal funds rate. Please know about the federal funds rate. Know the banking system, the idea of deposits, required reserves versus excess reserves. Multiply the excess reserves times the multiplier, get an effect. The Federal Reserve versus individual customers and how money goes into the bank is different. If the Fed is buying bonds, the money that they use goes directly 100% into the banking system, into the banks. It goes straight to excess reserves. When you and I put money into a bank, it goes through the fractional reserve system. Please know, when we talk about monetary policy, please know difference of buying bonds and or securities versus selling bonds and or securities. Buying bonds bigger makes the economy get out of a recession. Sell smaller deals with inflationary times. Know that we buy for expansionary, we sell for contractionary. We talked about interest rates nominal versus real. Know the Fisher equation, that the nominal interest rate is equal to real plus inflation, or that the real interest rate is nominal minus inflation. We learned the money market graph, so you don't have to draw it on this test, but know its movement, that the money supply moves, causing nominal interest rates to change. We talked about the equation of exchange, MV equals PQ. Know that V stands for velocity. That has to do with how often we are paid. It stays fairly constant. So if M, the money supply, changes, so does P and Q on the other side. That should do it. If you look at the handout, if you listen to what I've just said, if you've paid attention, if you read the chapters, if you look at the study guide, E, all of the above, you should do just fine. Okay? Anything else? Ask me in class. See you then.